What is the risk here of a recession?
I think the risk is very low. The reality is demand for labor continues to be very, very strong. The inflationary pressures that we're seeing are primarily supply side driven inflation. And if the Fed can be effective in sort of taming that, I think we all recognize that monetary policy may be a blunt tool, right? But given that supply side inflation, they probably can't really control supply chains being backlogged, manufacturers not being able to get goods on time, but they can raise interest rates and sort of ward off demand. They can raise interest rates, particularly when we look at some of the more stickier parts of inflation, things like shelter prices, owner's equivalent rent. For example, if the Fed raises rates, this directly impacts the affordability in the housing market. And I think that could sort of slow some of the more stickier parts, like that shelter inflation piece that tends to get talked about a lot, and overall demand for goods and services throughout the economy as well. So, monetary policy may be a blunt tool, but it is somewhat effective in warding off, I think, some of the inflationary pressures that we see bubbling up as we look forward to 2022.
John, so where does that leave us in terms of the cycle? I'm hearing a lot of people increasingly talking about the fact that we are late cycle. And if we're late cycle, we need to start adapting the way that we're investing right now, particularly in equities.
Well, I think real rates continue to be very materially negative. And we typically late cycle, we start to see real rates start to move at least towards zero and potentially into positive territory. And so, I think it's a little bit premature to say that we're late cycle. I think what we can say, though, as we think about positioning, is that the easy money has been made. This is an active market in which you want to be doing a more bottoms up approach in stock picking. And so I think, again, the easy money has been made. And so as we move to a period in which the Fed is tightening, there's a big question mark on how much fiscal stimulus is going to come through if Build Back Better makes its way through. And so I think this is just in turn, you want to have a bottoms up approach, an active approach to the market today.
You mentioned the cooling of shelter inflation. Barring a recession, which asset prices are you most worried about in the next 6 months?
I still want to see how auto prices develop, how energy prices develop, and this is in energy more so having an impact on the headline numbers. But we want to see if used autos up, north of 20% year to date. It's unlikely for that to persist. I think energy prices is also another question mark. We look at oil inventories across the globe; they still remain relatively low relative to history, so that could still provide some support for energy prices. Of course, jet fuel demand is going to be pretty important. And so as industrial or airline travel potentially takes a little bit of a breather as a result of Omicron, that could potentially keep oil prices and energy prices overall a bit elevated. So those are some of the more, if you will, quote unquote, transitory pieces of the inflation aspect that I'm going to be continuing to watching in the hopes that they'll start to cool in the quarters ahead.
Jordan, do you think we're going to see significant volatility next year? And if so, do I want to be fully invested, or do I want to think about having dry powder to take advantage of some of those dips?
Well, I think you absolutely want to be fully invested. I mean, the reality is that's the reason why we diversify our portfolio, right? Because we can't really tell what sort of black swan event is going to happen. And for those investors who have sort of been sitting on the sidelines all through the third and fourth quarter, waiting for a pullback, you've continued to see the market sort of continue to grind higher. And so you don't want to be sort of left on the sidelines. I think how you play it is you try to mitigate your downside. You use sort of hedge products, derivative options to sort of help mitigate some of the downside risk within portfolios. But I think you certainly want to be fully invested, particularly when cash is giving you a negative real return.
When you look at the market right now, are you still worried that people are taking on a little bit too much leverage given where we are in the cycle?
Not too concerned about the leverage picture. I think when I look at the markets more broadly, we're currently in a period where liquidity is sort of a bit shallow as you're running through the holiday season, so to speak. I think as we move through the fundamental picture, as we look towards to next year, earnings growth is still expected to be relatively robust. I do expect buyback activity to pick up as well as we move over the course of next year. And again, I think a resilient consumer is going to provide a lot of support for the fundamentals of the market more broadly. And so I think, even though while, a lot of talk about moving late cycle and investors should try to be deleveraging, I'm still of the opinion that I'm a little bit more optimistic than I am pessimistic about market returns next year.